Hi, this is Michael Waits, and welcome back to This Month Amplified. David Gritz, a co-founder and managing director of InsurTech New York, is with us as always. David, how are you doing?
I'm doing great today.
It is awesome to have you here. Hey, by the way, did you by any chance get a chance to listen to the episode with Andrew Johnston?
I missed that one, but it sounds like I should definitely tune in.
Oh, come on. This is the seminal report. He puts this thing out every quarter, right?
Yeah, we actually
State of
had
the
him.
InsurTech market. Sorry, go
We
ahead.
had him live after the last quarter one.
Did you really?
Yep.
Okay, you got to listen to this thing. Anyway, let's go ahead. Let's talk about the yen carry trade. This is something actually that I've been talking about for 30 years. I want to say 25 years. Yeah, if you feel like the yen carry trade started in 1999, we can talk about that as well. But I mean, I lived and worked in Japan for 20 something years, and I traded FX markets, I traded the bond market, and I also traded equities. So go for it. What do you think about this? Tell me.
Yeah, well, so I think there's really two perspectives, right? There's the historical part, and then, where we are today, and then ultimately, what this means for the future of what's possible from, a sovereign nation perspective. So, historically, just as a starting point, ultimately, it's always logical to put capital wherever it makes the most sense, right? And if you have a place where you can get very low interest to lever up, then you would do that. And I think ultimately, if you look back to when the Japanese economy was at its peak, I think there was data that basically said the Japanese palace real estate was worth more than all of Manhattan.
No,
So,
no,
you know,
all of California.
all of California. Okay.
Yeah, all the real estate
So,
in California. That was the deal they were making back then. But go ahead.
yeah, so at that point, all of the Japanese companies were coming to the US and buying up assets, and it made sense because their money, was worth more than the American money, and they were able to take advantage of that. But, after the crash and then, interest rates became negative, then people pivoted and said, wow, like I can get this capital super cheap where they're basically paying me to take the capital. And if I have other better uses for it, I might as well. And this is a representation of how global our financial markets are, and how, I would say, enterprising people that are looking to deploy capital are. So it's kind of like a function or a feature of the system, not necessarily a fault of the system.
So let me give you one more piece of very relevant information. In 1980, at the end of 1986, beginning of 1987, when I was graduating from college, Morgan Stanley hired me because I studied Japanese in college to go to Japan. And I'm not going to remember the exact rates at the time, but let's say the yen dollar rate was like 160, 170 when they promised me this job and they hired me to train me and send me to Tokyo. That was the idea because the office in Japan was growing so fast because of this boom in the equity markets. But by the time I got hired in June, the rates had moved like 20 or 30%. And they were like, yeah, we're really sorry. You still have your job, but you're definitely not going to Japan. And this is just the impact that the FX rates have and just how volatile they can move. It's not just today. This has been going on forever. Anyway, go ahead. So talk to me more about the yen carry trade. You want to define it, maybe?
Yeah, so ultimately, how any carry trade works is ultimately a corporation, an individual, or a financial institution takes a set amount of capital in one currency, transitions that capital or exchanges it or hedges it in another currency, and then they take advantage of what that other currency has to offer. So that other currency, at least in the Japanese economy, had to offer low interest rates because
Zero,
when yeah well, at
essentially
one point
zero.
negative, right?
Yeah,
I mean,
negative real
obviously they
rates.
weren't lending at negative rates, but functionally, if you're able to get leverage at much lower prices, then you can theoretically use that in the Japanese market or other markets that will allow you to kind of use that leverage from the other currency.
Yeah. So essentially, what happens is you're sitting there with dollars in the United States, and instead of borrowing dollars to leverage a trade to buy something in dollars, you take those dollars, buy yen, or borrow yen, which you can borrow at 0% or close enough to zero that the money's free. And then you say, well, what can I buy with that? The other thing, again, because I mentioned this, the yen was stronger then, right? So now you're buying low interest rate, you're borrowing at low interest rates in a currency that's strong, and then you go back and you buy stuff that has a higher yield, right? And at the time, you could make like a 5 to 6% difference in the trade, but your big risk is what? It's the move in the currency. Because if the currency moves back 25%, then you don't just lose your gains, you lose more than that, right? And that's the big problem. Anyway, go ahead.
Yeah, so ultimately, I mean, the dollar yen pair is just one example, right? There was a point in Europe when, their rates were very low as well. So that carry trade is not restricted to one currency pair. And it also can be a multiple currency pair simultaneously. And a lot of companies use the difference in currencies as a way to hedge. Like, if you earn a lot of your income in one economy, but you ultimately don't have the expenses in the other economy, you might want to hedge. So then your operations are not impacted by the changes of the currency, which, there's an entire market of people that provide liquidity for that.
Exactly. Exactly. So what's going on now? Like, why is this relevant today?
Yeah, so if you look at the other pairs, right? So the first pair to unravel was the Europeans because they more or less followed suit with the U.S. and raised rates. But the Japanese have been the longest ones to hold out, and now finally they're decided, hey, it seems like our economy's okay, and we're going to raise rates. So now people that are those holders are impacted by two things. One, their cost of capital going up, and two, the change of the value of the Japanese currency, which is now meaningfully weaker.
Right. So I think here's the thing. So I'm experiencing this still every day. My wife lives in Japan and I earn money in dollars. So I send her money, right? So if I send her, let's just pick a round number like $5,000 and the rate's 140, then she gets 700,000 yen. But if it goes up to 156, she gets way more yen, right? This happens every single day. But here's the problem. The markets are predictive mechanisms, right? So if they think, because rates right now, the rate differential between the US and Japan is still really high, right? What is it, 25 basis points for short term rates in Japan? And the
Right.
Fed
And
funds rate is what, 5.3, 5.25, something like that. Yeah.
yeah,
But
exactly.
the Fed has hinted, although recently they came out and they were like, maybe we won't do this. But the Fed has hinted that rates are going to go lower in the United States because the threat of a recession is maybe slightly higher, they think. And also inflation is coming down in the States. But in Japan, as you said, they've had rates close to zero for 30 years, 25, let's give them, right? And they're signaling they may start to raise rates. That interest differential is going to close. And I know there's more than just one FX pair, but that means that this yen carry trade could begin to, and maybe it's already starting to unwind because the markets are signaling that interest rate differential, which also drives FX rates, is going to close. And that's negative for this type of trade. Yeah.
Yeah, and I think it's probably for the listeners here that kind of come from the insurance industry, it's worth noting that this could have a significant impact on the reinsurance markets because there's a lot of significant players that are Japanese carriers that own US companies. So, Tokyo Marine owns Safety National. They own, Houston Casualty Company, Philadelphia Insurance. They have two reinsurers, the Houston Casualty Company and Kiln. Daiichi Life has a U.S. life subsidiary, Protective. So, yeah, Sampo is another one, and Sumitomo owns Symmetra. So essentially, if it's more difficult to move capital from Japan to the US, ultimately that means from a reinsurance standpoint that we may have less capacity for catastrophe bonds. We might have less capacity for writing new business. And this is already a tough time when essentially most of the traditional insurers are looking for more capacity to cover the risks in Florida, California, and some of the other states that have pretty substantial perils caused by weather.
Yeah, I love this segue into the insurance industry, right? Because This is a direct influence on the application and the availability of capacity, right? Because in some sense, not every Japanese company is doing this per se, but they're also involved in this carry trade, right? Because they're allocating money from one place to a higher yielding other place. And it means they can take more risk because they feel like they're getting a higher return for that risk that they're taking rather than taking it in their own country. And this could have been true for the euro as well, right? Because as you said, it's not the only pair.
Exactly. So essentially, what it means is like in the next, you know, significant number of months or even a couple of years, this market for insurance linked securities at the highest level, and then reinsurance, and then carriers that need to buy reinsurance is going to it already is expensive because we're in a hard market, but it's going to stay
Yep.
expensive for at least until this trade unwinds.
Yeah, and I think people sometimes lose sight of the fact. I mean, not you and I, but I think sometimes people lose sight of the fact that insurance companies are also separate to the business that they're normally running, run massive investment portfolios as well, right? And those are very international, right? They're not just like a big Japanese insurance company is not just investing in JGBs and in Japanese stocks. I'm laughing because the thought of it is just hysterical. Yeah.
Yeah, exactly. And they may also have hard assets that are much more difficult to liquidate and
Yep.
adjust.
Exactly. Yeah, this is a great topic. Is there anything else you want to cover here? Or do you want to move on to the Sahm rule?
Yeah, no, I think we caught all the key points here and the impacts.
Go for it. So, what is the Sahm rule? And like, do you want to talk about just maybe the definition of this thing to start again as usual?
Sure. So essentially, everyone wants a crystal ball to predict when a recession is coming, right? And there's common ones that everyone knows about, like, the inversion of the curve between twos and tens, or fives and 30s. I'm talking about bond timelines. But those are common ones. The other common one is the PMI index for either manufacturing or services. So once that's under 50, that usually means contraction, right? But ultimately,
Also, also falling GDP growth for 2 quarters in a row. Isn't that the thing?
yeah, well, that's kind of like a rear looking one, right?
Yeah, yeah, yeah.
So so typically, people like to think that employment is forward looking. The problem is all of the data we get for employment is almost always rear looking. Like in other words, the ADP survey and the
Yeah, yeah.
BLS report,
BLS survey.
they don't come out in real time. You find out the previous month, the next month, and then it's usually revised.
Revised. And those some of those revisions can actually be huge.
Significant. Yeah,
Yeah,
absolutely.
very large. Sorry,
So
go ahead.
so the Sahm rule was basically, and I think it was a professor in the 30s that came up with it. And the idea is that employment does not change linearly, it actually changes like exponentially. So what happens is typically employment's under a certain threshold and then it rapidly increases until it reaches its peak. So the question is, if you're looking at the future employment in order to predict a recession, it's already too late because that peak happened in such a short period of time that your, recording or data window is not always effective enough. So the Sahm rule says, how can we look at these little changes like month to month in order to make a prediction? And is there a certain threshold? So the threshold that they determined was for 0.5% change, essentially from the lowest period to the next measured period. So, it could be a set number of months or, a quarter, that ultimately, when that happens, that's a warning signal that the recession is going to happen imminently. And imminently is not exactly defined. It's usually in like 3 to 6 month time horizon. But what's really interesting about this versus a lot of the other indicators that I started with is almost all the other indicators had been determined backwards looking. So in other words, they came up with the indicator after they already saw the indicator could be applied to historical situations. They're like, oh, this must work. It's only been back tested. The Sahm rule is one of the few ones where it was actually defined and theoretically created, and then it was tested after it was created. And I think all recessions except for there might have been one, the Sahm rule had applied.
Interesting. Very interesting. Yeah, so I'm looking at the Wikipedia page for this. It comes from a chapter in the Brookings Institution's report of fiscal policy. Yeah, and it was something about yeah. Anyway, so you nailed this. So where is this used and what's the impact for today? Are we, because I hear all this news out of the United States, are we heading into a recession? It doesn't feel like it since, as you said, the employment numbers, which are backward looking, have been really good for the past months and months in a row. The unemployment rate has been below 4%. Is that true for like the longest period of time in American history? Like what's going on here? Why is this Sahm Rule so important today?
Yeah, so I mean, I think the Sahm rule is important because it helps us ground ourselves to answer the question, is this time different? Because ultimately, every time you're forecasting some kind of economic phenomenon, it's not like physics where it's deterministic and you can ultimately get down to a pretty close to specific answer. It's a social science, so ultimately there are times where things are different because the course of reality for how humans interact changes over time. So, because the Sahm rule is so empirical, a lot of people go to it and say, this answers the question that, no, this time isn't different because there are a lot of different phenomenon that we've been applying and using financial engineering that are different, right? Like our GDP to debt for most countries is different. The use of tools like quantitative easing is different. The relationship between bankers like the Federal Reserve and government institutions is different. Arguably, they're less independent than they used to be, and ultimately, like our level of political divisiveness is pretty high. I mean, I wouldn't quite say is like World War II level, but theoretically, it's pre-Civil War levels. So
Yeah.
all of those things are different than when we look at some of the more recent recessions, and we also live in a post-COVID world, which not a lot of people are using data from the first flu in 1918 and doing all their analysis because it's one data point. So given all of those things, I think the Sahm rule is a very useful data point that we can use to help drive our decisions. And I think this is one point that is really important. As Michael, you said, like everything feels great. And, if you look and read articles back in 2007 or in 2000, you know, everything felt great until it wasn't. And, I think maybe the difference in 2007 is the insiders were actively betting against things. And, I would say if you worked at Cisco or Webvan in 2000, you probably knew that, the numbers were not what you were telegraphing to the rest of the universe. But ultimately, most of the impact of the changes happen when there's like a herd mentality. And, you know, there's certain things that are episodic, right? And episodic is kind of like there's a critical threshold until something happens, and the Sahm rule is one way to estimate what that critical threshold could be.
And are we at a point now where the unemployment rate is going up by 50 basis points month over month? Has that happened
It's
already and I just haven't noticed?
it's not month over month, it's from the lowest
Whatever
point has it
period.
gone up.
Yeah,
Yeah, and it has, because I think the lowest point was like 3.7
something
or
like that. Yeah.
yeah, and we're at 4.3 now, so it has been triggered.
Huh, interesting. Do you think this is like a self-fulfilling prophecy? And do enough people understand the Sahm rule, right? So if you're sitting there and you're the head of Microsoft or you're the head of some big company, you're looking at this and you're thinking, uh-oh, this Sahm rule's just been triggered, so we're going to stop hiring people or we're going to stop investing so that like it fulfills itself. Do you know what I mean?
I don't think it's enough of a phenomenon because it's like not covered in the mainstream media. I mean, there's definitely
Yeah.
people that post on it. You'll probably hear it on like a Bloomberg options, podcast or something like that. But ultimately, it's one of those factors that's emergent, right? So if you think about what it actually means on the ground, microeconomically with individual humans, right? So ultimately unemployment rate can be translated to amount of people working. So let's just say for super simple numbers, right? If there's 100 million people that work in the US, right? And each percentage point is 1 million people. So 500,000 people are not working because of this change in unemployment. And I think there's one thing a lot of people don't think about when they think about unemployment. There's different levels of unemployment that are measured by the Bureau of Labor Statistics, right? So there's the most common one that we think about, which is like full-time employees, right? And usually that's the numbers that are quoted. But there's also like part-time employees that can't get as much work as they want, or there's also people that have given up on looking for work. And oftentimes those numbers are significantly higher and change, but they're just not talked about as much as the clear simple number of full-time employees, because that's easier to relate to for the majority of people that think about statistics.
Yeah, and unfortunately, you're right. Like these labor statistics kind of go both ways, right? So this idea of I've taken myself out of the labor force, I've given up on looking for a job, in a way lowers the unemployment rate because I'm no longer saying that I'm actively looking for a job. On the other
Exactly.
hand, but on the other hand, the other thing that happens again, and people don't talk about this part of it either, is that when the economy is growing and when unemployment gets really low, a lot of people look around and go, maybe it is time that I stop looking for a job and I come back into the workforce. And maybe that's just a short term, and I don't know, right? Because I don't follow it that closely anymore. But then there's a short term blip in another 500,000 people are looking around going, there were 280,000 new jobs last month. I should be back in the workforce looking for a job. Do you know what I mean?
Yeah, absolutely. But I think there's one other factor that a lot of people are not talking about. But I talked to a couple recruiters about this, which I think is actually kind of concerning. Which is a lot of companies, what they do is they post a job, right? They interview candidates, they select a candidate, and ultimately they've now hired that candidate, but they leave the job posting open. And there could be a number of reasons for that. The most logical reason is, well, what if this candidate doesn't work out? I'd like to get a couple more people, especially with perceptions in the workforce that, Gen Zs are not very loyal employees. Whether that's true or not, that's not really the point of this podcast. But I think, there's clearly a perception of that. So, we might as well cover our bases. The other is just, there's so much work to do as a HR person or a hiring manager. I don't have time to like manage it. Like I'll just whatever. It's open, just ignore it. And to be honest, it's probably something we might have done once or twice before. So yeah, you just forget, especially for like internships, right? Like every summer we hire like 5 to 8 interns, and sometimes we want to leave it open. Other times, like I forgot all the places we posted, didn't close it for one. And usually for that case, it doesn't matter because it's seasonal. Like
Yeah.
after the end of May, no new people are going to apply because they already got their internships.
So
But
I'm gonna give you another anecdote, another way this works, right? Because I saw this at Goldman Sachs, and maybe I'm not saying it was true for the entire company, but it was definitely true for our trading desk in Tokyo. Here's what we did: we always had a job available, always, maybe a few of them. And part of the reason why was because we knew that during certain parts of the year, people would leave after they got their bonus or whatever, and you were never sure who was going to leave and how many people were going to leave. So you were constantly interviewing people, even for jobs that didn't exist, because you were kind of sure that a job might exist. And if you start the hiring process or the interviewing process when that person leaves whose job you want to fill, you're behind the eight ball already. So we were just like constantly interviewing people, and if somebody left, we were like, let's hire that guy Bob because he was really good, even if that
yeah, well,
job
and I
didn't
think
exist. And
the
and that
difference
and
today from when you were at Goldman is at that point you actually had to take out an ad in the classifieds or another place where you had to pay someone for the privilege to have the space. Today, you can use
yeah,
the
it's
basic
free.
level of Indeed for free, LinkedIn, the basic
Yeah.
level of it is free,
So it's even
Handshake
worse
is
now.
free. Yeah, so the frictional cost of posting a job is cheaper because it's
Yeah.
cheaper to post, and not just that, but another barrier was writing a job description, and now ChatGPT can do that for you in 2 seconds. So,
A JD. Yeah.
almost all the friction to posting a job has been eliminated. So that means that, like, even the best data and statistics we have from pulling from these databases is not accurate, because there's very few ways other than a survey to validate the quality of job openings. So I think that's another statistic that is a
Yeah.
little bit different. So all that being said, like going back to the Sahm rule, if 0.5% changes, there might be a shadow 1% of part-time people that couldn't get it, or people that stopped looking, or other factors that impact the jobs that make a bigger impact. And ultimately, if there's less people earning income, there's less money that they can invest, and there's also less money they can spend. And in the US, 70% of the economy is consumer spending. So there's an outsized impact where if consumers don't have a job, or less consumers have a job, there's almost like a magnifying effect, because if you're not going to buy the Lululemon tracksuit pants, then maybe Lululemon won't hire another person, and that person that otherwise would have been working at Lululemon is not going to buy a coffee at Starbucks. Starbucks is not going to hire someone, and then maybe that person at Starbucks was studying their PhD in data science and just wanted an extra job, and now they're not going to go to work at Intel because Intel just laid off a ton of people because someone bought one less laptop.
Right. I mean, look, employment definitely drives the changes in the velocity of money for sure. Right. And that's kind of what you're talking about. So fair enough. But let's talk about this in a little bit more detail. You sent me an entire chart because the BLS publishes this every month, not just the employment change at scale, but the employment change by industry. And you did mention ChatGPT, which is artificial intelligence. It's like the poster boy for artificial intelligence. Do you want to talk a little bit about, is AI influencing jobs in IT, just based on the fact that if you look at this chart for July, right, that you sent me, it's like the biggest drop in
Yeah,
July.
compared to
You
all
want to
the
talk about
other
this?
industries. Financial
Yeah,
services was also reduced too, but
a
yes.
little bit, but not not at the same scale as IT. You want to talk about this?
Yeah, so essentially what's been happening with IT is, like, ultimately the most early adopters of technology are the people that are, technology as a first language, or, technology savvy, so to speak. So, a lot of us think about how we could potentially use ChatGPT. I gave the example of using it to write job descriptions, but the magnitude of impact of ChatGPT in technology jobs is so much more users. So what that means is it's going to impact their work more, but their work is more susceptible to impact, because if you think about the concept of generative AI is most effective for creator industries. And what is more of a creator industry than someone who spends the majority of their time creating software, which has no physical connection to reality? So if you ultimately are using a tool to help you create things faster, then your productivity could be faster. I mean, there's people I talk to, including a startup founder that's building a tool to compare productivity of developers, and he said, ultimately, if you use the right chat gpt, or large language models, or other applications of traditional AI, not even generative AI, that ultimately what you could do is take work that you otherwise would have to really think about and specify and draft, and the machine does the majority of the drafting for you, because it's much easier for the machine in a couple seconds to write the code that might take you an hour or two. So when there's that significant of productivity changes by people that are very good at using it, then it's going to be clear that you don't need as many people to do the same job.
But is this just so, you make a really interesting point when you say that in the IT or information services, I think, which is what it's called in the BLS report, they've been using this for 2 years longer than everybody else. They're power users. They know how to use it better. Do you think it may be the case? And this is just me being slightly devil's advocate. I feel like I've been doing that this entire show, but the fact that maybe that they're going to peak in the extent of the drop of productivity as well. Do you know what I mean? In the sense that since they're so far ahead of the curve, that the impact is going to start to minimalize there and maybe increase in other places, particularly like even education and health services, which just saw an explosion of jobs. But there's got to be a whole bunch of automation you can do there as well, no?
Sure. So, theoretically, IT will peak in terms of like the use and declining marginal returns earlier than everyone else. But I would argue that there's a lot more that can be done, right? So, if you break this out, so the most advanced people in IT are the people, writing the large language models and theoretically could be using a large language model to write another large language model, right? So, we'll just call these the elite people, and they're already like the most ahead of everybody else, right? But then, there's mid-level IT people that maybe just are impacted by some extent. They have a mandate in their company that they need to use it, and they're kind of top level developers that want to always stay ahead in their career. And then there's like the slowest of the slow of IT. These are like the insurance industry IT people that are still running on mainframes, and they would love to use ChatGPT, but they're not quite sure how they get the prompt in their AS400 green screen. So they're hindered by the hardware that they have, and their draconian policies that they need to get 17 levels of sign off to add a new software that they can use. And they also have privacy concerns, so they can't submit anything except to their extremely limited enterprise LLM that's only allowed to be used by 5 people. So those people, they're pretty far down the curve, and it might be another decade before they're in line with all the rest of the IT people.
Ouch. Ouch. You must have missed breakfast today. Yeah, there are definitely different cohorts of people that are further ahead on the curve and some of the people that are behind on the curve for sure. Do you think that this is going to start impacting some of the places where jobs are growing dramatically? Like I'm looking at the construction line as well, and transportation and warehousing. At some point, artificial intelligence is going to start impacting all of these industries. Yeah, but I do think,
I
but
think it
I do
will,
think
but like I haven't quite figured out how to use ChatGPT to, install
drive a
kitchen
truck.
cabinets and,
Yeah.
do drywall and electrical work. So, until it has a physical essence, which I know they're working on. I've seen some of these like robots that have, Gen AI in them, but those are going to be probably lagging even behind the insurance IT people.
Look, I want to say I've said this for years, and since I've seen so many tech cycles, I do believe that even if in the short term jobs are eliminated, new jobs will be created by people that know how to use the technology. So I'm not so worried about that over time. Anyway,
Yeah, no,
um,
I think, but usually what happens is the role destruction happens before the new roles are
for sure, for
created.
sure. Yeah, but I do, and here's the other thing I've seen though over time. But I do think that there is a point here where the cycles are so much faster that at some point, it isn't going to be the case that those jobs will disappear before the new jobs are created.
Well, I mean,
Anyway,
arguably in this case, some of the new jobs were created before the jobs disappeared. Like there were people hired that just did Gen AI before people even knew how to use it. So I think we're there in some sense, but we're just not there everywhere.
fair enough. Okay, is there anything else you want to cover before I let you go?
No, I think we got a lot of interesting topics today.
We definitely did. Let's do more of this, David. Okay, David Gritz, a co-founder and managing director of InsurTech New York. Thank you so much for doing this month. Amplified. Thanks, man.